Hey guys, and welcome to the first section in the Discord. This section is Trading 101, meaning that learning how to trade, even if you know how to trade, or also if you don't know how to trade, learning how to trade the way you should be taught in the beginning, the way that institutions and people think when they make money, right? The ones that make money, they think like that. And there are some key differences between what I'm going to tell you now and basically anything else you'll see, you know, on the free internet, so to speak, and also most paid groups as well. If you go very high into the price range, or you talk to some institutional investors, then they might tell you similar things than me. Basically, when you trade, right? You have the market, and the market's moving, and it's dynamic, and it adjusts to other markets, and it's a chaotic place, right? So how do we make money in a chaotic place? We try to find patterns where, if this happens and this happens, the likelihood of the price going up or down in this specific scenario is higher than 50%. And if it is, it doesn't have to be higher than 50%, by the way, but if it is, and our equation adds up, then we will make money. So that is the base idea of it, right? And many people get that wrong in the first place. Like, how do you make money? Yeah, I just got this huge trade, I just got this 3 winning trades in a row, I'm gonna be a millionaire, stuff like that. Like, yeah, okay, when someone tells me that, like, yeah, okay, well, what's your strategy, right? What's your hit rate? What's your risk to reward, right? And those are the main two key things, basically. It's risk to reward, and win rate. Win rate means percentage-wise, how many trades do you win versus how many do you lose. And the risk to reward is how much do you risk to how much do you gain, right? We'll get into some examples later on. But yeah, in front of me I have our dashboards right now, plus the simulator. We'll get into it, but this is just to give you a pretty good idea about, how strategies work, and what they do. So I'll just start showing this, and then I'll start with the explanations. So let me just log in here. So right now this is just me here because it's in your Discord, but here are one of our bundles, right? What's a bundle? Well, we just said that a strategy is, pinpointing a situation in the market and then capitalizing on that specific situation, right? When you take any strategy, then it will have good times and bad times, right? I was sitting there, trying to figure out a consistent way for our hedge fund. Our investor wanted consistent results, and we just tried to figure out a way how to do that. And we always saw with every strategy, basically, because that's how the market is designed, with every strategy, basically, there was at least 1 or 2 times when we backtested it where there was like a big dip down, and that was not acceptable with our investors. And no matter what we did, it was there. And then when we tried to like force it, we would just overfit, and the entire strategy would break. So we would not find, for a long time, a consistent strategy. And then, paradoxically, as we applied this approach that I'm about to tell you, we started getting strategies that were more consistent too. And, I'll show you one strategy that's incredibly consistent. It's probably my favorite strategy that I've seen ever, which one of my friends created. Yeah, so we were basically trying to figure out a way how to do that. So yeah, you have a strategy, and then you have dips in the performance in the strategy. That's completely natural, but we did not want to have that. So we were like, okay, well, let's look at it with a higher perspective, right? Let's go one step higher. So we have a strategy. It has ups and downs. Let's see we isolated the environments where it did well. Let's isolate the environments where it did not do well, right? And we could not, just segment the strategy out of the time where it did not do well. It did not really work like that. However, we can make a new strategy that works exactly well when the first strategy does not work well, right? So we get 2 negatively correlated strategies. So when one's doing good, the other one's doing bad, and vice versa. But both of them are profitable over the long run. So we're like, okay, well, this makes sense. Let's try and bundle them together, right? Let's try to put more strategies together, each strategy working when another doesn't work, right? And we put them into one, and then that's the one strategy. And turns out that that works really well, because instead of focusing, narrow focus, this is again one of the lessons, the difference between retail traders and institutional traders. Institutional traders look at a higher perspective, whereas retail traders are super focused on one thing, right? So rather than being super focused on one thing and trying to force a strategy, we took a step back and we were like, okay, well, this is a fact. This is how it behaves. This is the realistic situation. We're not trying to be optimistic or pessimistic. This is what it is. How can we do it better? Okay, well, if we bundle these strategies together that are negatively correlated, meaning that they're basically helping each other out or they're covering for each other, and we put them into a bundle, then that seems to work well. And it did. And, that's how our first strategies got born, essentially our first bundles got born that were, actually performing very, very well. So here, what you can see is bundle 1, and this is the performance of bundle 1. Here on the side, we have 4 bundles that I have on here right now, and their performance in the past, I think like 2 months, 1 or 2 months, something like that. And this is the performance without leverage, right? We will get into leverage very soon, but this is the performance without leverage. And here I have the 3 separate strategies that I can change the allocations to, right? This is also interesting to say, and I won't get into the details right now, but the way we're calculating the data for these strategies is different than the other strategy, any other data that you look at on TradingView or any charts. It's a different way we're calculating the data, because we're kind of looking at intra-candle data in every time frame. We'll get into it later on. You don't need to know that now, but this strategy, the turtle, only works well if we have the pre-processing of the data done, and that takes a couple days to do, which is not done yet for this Discord. So as that is happening, I will be increasing the allocations in this strategy. However, on the bundle overall, we have an 81% hit rate, right? 81% win rate, and your equation is very simple. Let's assume that you have a market, right? Let's go to ES or ETH. It's fine too. Right, let me just go to ES here. And let's say this is some bots that I'm doing here. It's a pretty good short, but let's assume that you go into short, or you go into a trade every time something happens. Let's say, for simplicity's sake, the stochastic here, every time it stopped or bottomed, you go short or long, right? When you take that trade, and you assume that when the stochastic's here, that the price is going to go down, which in this case happened, right? Let's assume that every time that happens, the move is at least 1%, right? Let's say 0.5%. The move is at least 0.5% on ES. So what we're going to do is say, okay, well, I will set up a trade here. And with that trade, sorry, there's a dog right next to me. With that trade, I will try to gain 0.5%, and I will try to risk 0.5%. Meaning that my risk to reward is 1. So here, what I want to get is I want to get 0.5% out of this trade, and the worst that can happen, the worst I can lose, is 0.5%, right? So, look at it mathematically. If my risk to reward is 1 to 1, right? So I risk 1 in order to get 1, and my win rate is larger than 50%, I will be profitable, because my trade is basically a coin flip, right? And I'm risking 1 in order to get 1. So at 50%, I'm at a coin flip. At 51%, I'm profitable. At 55%, 60, 80%, I'm getting more and more profitable, right? But that doesn't mean that, your win rate needs to be 50%. It could be 20% if your risk to reward is 10 to 1, right? Because you don't need to win that many trades, because when you win a trade, you get 10 times the amount that you risk. So really, you only need to win 1 out of 10 trades. I hope this makes sense. We'll get into it in more detail, but this is the main thing that people somehow overlook, which is, okay, what is my strategy? Rather than having it dynamically, I will isolate it to be like, okay, this is my set risk to reward, and when I have the set risk to reward, I know my win rate, and if it adds up, it adds up. If it doesn't, it doesn't, right? And then the second layer on top of that is, in different market conditions, the strategy can perform differently, and that's why we have our bundles, right? And our bundles are designed in order to blend the strategies together and have a consistent performance over multiple market situations, because those strategies are made so that in every market condition there's at least one strategy that works well. And there's a few strategies we have here. This bundle, for example, you see it's more consistent. The volatility, the ups and downs are smaller. It's more of a straight line, and that is because there's a lot of strategies here, right? And here you can see, what's live trading, which strategies are live profiting right now. Here you have your trades, and yeah, now when you increase the leverage, then you will see an increase in performance. Which basically means that if you don't know what leverage is, you can look it up, but essentially you're borrowing money from the exchange. For example, I have $1,000, right? But $1,000 is not a lot to trade with, so and I want to trade with $10,000. So I set my leverage to 10. I borrow $9,000 from the exchange, and the maximum that I can lose is $1,000. The collateral that I put in, right? If I lose that, then they will just kill the trade and they will kick me out. I cannot lose more than I put in, which is $1,000. The difference is that, when you trade without leverage, something going to zero is not happening in stocks or forex or whatever. In crypto it might, but in general that can't happen. Your investment cannot go to zero. However, if you leverage up, if you use 10x, 20x, it can definitely go to zero, right? So it can go to zero because it's multiplied, but the risk, the maximum that you can lose is not multiplied. It's the same amount. It's the $1,000 at the beginning. So as I go up in leverage, you will see that my performance is going higher and higher. So now when we start this strategy or this bundle, and if we would just let it run with not doing anything, you'd be at $77,000. And if we go higher up, we're at, and this, by the way, live simulated. This is something that has been running, right? So this data is live, or this data is actual data, right? So at a 5 leverage, we're at $120,000, and now we're getting up with the leverage, right? And what I'm doing now is I'm going higher and higher, but as you can see, the higher you go without any other management system, your equity curve starts being more volatile, right? The ups and downs are larger, and eventually it will break, right? And it will break because some of the trades are whereas normally the biggest loss here would be 10%, with a 6x leverage it would be 60%, so it'd be much larger, and by the time you get to a 10x leverage it'll be 100%, so it will break completely. And I'm trying to get there right now. It's not really working because we're at $200,000 profit, but let's just go to a crazy number right away so you can see it. It will just break completely, and this is the point that I'm trying to show you, if it ever lets me. While this loads, I can go here, and whereas these were the bundles, right, these are the strategies themselves. So here you see what strategies are in the bundle, and on this dashboard you can then actually look at the strategies themselves individually, right? So here you can see the differences in performance, and as you can see, here are the top strategies once again. And this strategy, by the way, one of my favorite strategies, the Bitcoin bully. Look at those win rates, by the way, right? These are super consistent strategies, and it's not that they have a bad risk to reward. That's why I like them so much, because the amount of losing trades here is minimal, whereas see the profits here, and this is without leverage, by the way. So if I would have to suggest any strategy to trade for anyone, it would be this one, which, by the way, you have access to, and you can set up your signals as well, so you can literally trade this. But it's so incredibly consistent in making profits that you can just have it run without thinking about it, and every single month you can just cash out an amount out of your account. This is what I suggest people to do if they have issues with their cash flow. So oh, there we go. Right, so it just broke, right? This is, by the way, something that never happens, but this just means that your strategy doesn't make sense anymore with that leverage. And the reason I showed this is because of this. So this is a simulator, right? And this simulator uses the data from the bundle and the strategies in order to simulate how we would trade something, right? So right now we're at bundle 1, right? Let me just refresh this. We're at bundle 1 right now, right? So these allocations here, they start at 10%. I need to make it 100. Once I make the sum of these allocations 100, then the strategy will start showing me something. So let's just do that. Let me just put the turtle on 80. So I'm at 80, 10, 10, which is 100, and it should start working right away if my Wi-Fi is okay. Let's just see and reload it again. Okay, so as you can see, it just broke down completely, and the reason that happened was because we did not manage the leverage, right? That doesn't mean that we can't use that leverage, but we need to manage it. So if you have a big account, right, if you trade with $100,000 or $1,000,000, right, then you don't have to use leverage and you don't have to risk at all. You start with that, and you get to $2.4 million, within like what, a year and a half or something, and you're fine. Like you're making $1.5 million or $1 million a year, and that's it. You don't need to over risk. But what do you do? If you don't have $1 million to trade with? Well, you need to be a little more strategic about it, right? You need to be a bit smarter about it, and you need to know how you're gonna manage the leverage, right? Because if you go too high, which is something that people do on average on Binance, which is a crypto exchange, the average leverage people are using is 20x. We just went to 17x and our strategy broke. What do you think is going to happen with the people going 20x, 50x, 100x? They're not like it's the chance of their success is zero because they don't have any strategy, right? They don't have this dashboard. They don't have a theory behind it. Here, by the way, on the strategies, when you go down and you toggle the description, you have some descriptions and allocation practices and everything about that, about strategies, right? Explain how they work, why they work that well. Which is something that most people don't have. They just over leverage. They just chase this 100% trade, 500% trade, and not looking at anything else, and just lose money, right? Once again, the rule that retail traders are focused in detail, whereas institutional traders, the ones that make money, take a step back and look at it from a larger perspective, right? So let's see if this one loads up. There we go. So now we just set it up, and we see a performance. This is without leverage, right? You just put in what is it, $10,000, and over 2 years you get $200,000. It's nice, right? It's nice, and this is the work of I don't know, 3 years of development and rigorous testing and tons of failures and whatever. And this is something that you can do right now, right? Which is great. If you have $10,000 and you're okay on making $100,000 a year, then this is what you can do. Which, with a very, very solid Sharpe ratio. If you don't know what the Sharpe ratio is, basically it shows you how good a strategy, or how the profit as opposed to the risk of a strategy is, or volatility of a strategy is. And everything above a 1 is good, everything above a 2 is very, very good. This is a 2.8. So yeah, this is the strategy that we've been looking at here, right, over a longer period of time, compounding. So now, however, right, we're like, okay, well, what do we do if we use leverage? Let's try a 2 leverage, right? What's going to happen? Well, it's going to change slightly if the Wi-Fi is going to work. And what's going to happen is that we will have more profits for a larger volatility, right? Which, is fine. But let's say, what if we want to use a 20x leverage? Well, if we set that up, it breaks again, right? However, that is because we're not managing the leverage. What we're doing is every single time we make a profit, we'll leave that profit in, right? And it's a 20x leverage. So let's say, the bully strategy here makes what, 5%, 3%, 7%, 3%, 6% a trade. When we 20x that, the percentage for the trade is exactly 120%, 60%, 60%, 150%. So huge, you start with $10,000, and 4 trades, 5 trades later, you're at, I don't know, like $60,000, $70,000. So that's extreme volatility, right? And because there's extreme volatility, there's going to be situations, even the smallest losing trades are a huge, huge deal in your portfolio, which is, irresponsible trading. People will do that all day. And, if they're lucky, they'll make a lot of money, most likely. If they do it for long enough, they'll lose all that money again. It's going to look like this, However, let's say we take the profits out. Because we're using leverage, we don't want to overexpose ourselves in the market, so we're taking more profits out of the strategy. And if we do that, look at that, the strategy is consistent again. However, it's not, it's not a 2,000% strategy, it's a 6,000% strategy. So now from $10,000, we got to $600,000 within the 2 years, right? So, and this is the difference of, I'm talking about this at the very beginning, because the first thing people will try to do is use leverage and over leverage, and I know for a fact that if I just show these strategies and make them available, people will go in here and start trading them with 100x or something like that, which is something that's not going to work, right? It's just not going to work. And that's why you have the simulator, where you can check out what leverage you can use with what profit taking, what allocations, and what starting value, in order to have a strategy that actually works and doesn't break down. Your goal is to, based on the allocations, play around with the allocations, look at the strategies themselves, see how consistent they are in the trades, and then check on the simulator that your strategy doesn't break. If it doesn't break and it's a consistent strategy like that, then that's something you can use, and that's something you can start trading right now, because those strategies are running on our servers. So you can just go on the website, start looking at the strategies. If you want, we'll set up some signals as well, and you can trade them, right? You can trade them, and you can just, well, invest in whatever crypto or other coins or other stocks or indexes, and the strategies are going to work. So yeah, this was a very quick rundown about thinking the right way in the market, building strategies, telling you why it's important to have a strategy in the first place, and then designing a strategy in a way where you're setting yourself up for success and not immediate failure, which is what 80% of people are doing. So yeah, just check out the dashboards, check out the websites, and play around with it a bit. I expect you to have some questions, which you should post in this channel, and based on those questions, we will continue making videos, continue making live streams, and building strategies together, so we get the first step out of the way, which is understanding the market, building strategies for the market. And then once we build the strategies for the market, we can use them, we can make money off of them, and then eventually we can leverage all of that work with prop firms. So yep, that is it. And if you have any questions, then I'm here, or anyone else in the Discord, they'll be here to help you out. All right.